Hello, everybody. Thank you for joining us. Welcome to today's FeedSci webinar on a digital first world, how to move from cyclical to risk event KYC monitoring. And today we are joined by Brian Farrow, Director of AML Products at FeedSci, Nick Parfit, Principal AML SME at FeedSci, and Andras Chair, Vice President, Principal Analyst from Forrester, our guest speaker. And Brian works with traditional and non-traditional institutions around the globe to meet market needs and demands by partnering with research and development teams to deliver industry best solutions and practices. Nick's AML experience covers more than 12 years, covering the full gamut of AML processes, technologies, and controls, as well as a full AML program reviews. And Andras is a leading expert on identity and access management, risk-based biometric, and multi-factor passwordless authentication, user account provisioning, entitlement management, federation, and privileged identity management. So we've got a lot in store for you guys today. In addition to our standard agenda, Andras will be giving an introduction kind of on KYC's relevance and the different types of KYC. And then we will hear from our FeedSci experts. We will also be having a couple of poll questions, so make sure that you're tuned in for those. And then this webinar will be made available on demand within the next week or so. Once that's published, everyone who registered will receive an email to be able to watch this again. And if you have any questions for our speakers, we have left time at the end for Q&A, so make sure to add your questions to the Q&A widget.
Hopefully everybody can see that with no problem. If not, let me know. But I guess maybe we will kick off with the poll question here. So for those of us in attendance, poll question number one is, where is your financial institution in adopting perpetual KYC? So it's a single choice question where we're looking to see if you're developing a perpetual KYC strategy, if you're testing it out, or if you're a little bit ahead of the curve and already in production with a perpetual KYC strategy. So as that poll is taking place, give a few minutes for folks to chime in and make a selection there. Okay. Do we have results on that we want to share, Lauren, or is it something we'll get to it a little bit later? Oh, there we go. Look at that. So looks like the majority of the folks are in the stage of developing a perpetual KYC. So I think that's pretty typical of what we've heard in the market. And we've got a AML survey, the results to that, which we'll share in a little bit. But first, what I really wanted to get into was a little bit more background about perpetual KYC and some of the things that we've seen in the market. So without further hesitation, let's get into the potential benefits of having a perpetual KYC solution over what is typically your legacy customer risk rating, CDD, know your customer. Really depending on the region you're in, there's different acronyms that are used for this. But really what perpetual KYC and what it is the ability to go in and proactively take a look at your risk scoring of your customers within the institution. So are you doing this at a perpetual basis? Are you doing this at a periodic basis currently? Is it something where you're looking at your high risk customers every 6 months? Are you looking at your medium risk customers every 2 years? Are you looking at your low risk customers every 5 years? And with that, it creates a lot of overhead, a lot of manual process that take place. So you're having to have a constant refresh of those high risk customers. You're having a constant refresh of those low risk customers. And what perpetual KYC really does is eliminates a lot of the need for that refresh process, that overhead of constantly having to go in and look at those customers at set time periods. because a lot could change within that. So what perpetual KYC really provides as a benefit over the legacy systems is more of an effective risk management. So you now have the ability to be proactive with the updated risks of the entities at your institution. So for instance, if you've got a high risk customer, you may not have any information change on them, where reviewing them every 6 months isn't really that effective because nothing has changed. And if you have a low risk customer who has changed occupation, changed the geography where they live, or maybe even changed their citizenship, just pretty basic examples of that. It's something they could have gone in and become from a low risk customer to a high risk customer, or maybe a medium risk customer. So it's something that you have to constantly evaluate. And if you're doing this manually, there's overhead with pulling those files, re-reviewing all the data points, the demographics, the different attributes to that profile, and making sure that they are changed or not changed. Well, having an automated process creates those operational efficiencies that you no longer have to pull those and manually review those. You could rely on a system to make updates to the risk score based off the changes in the solution, and seeing whether or not that is something effective in order to make it worthwhile for an analyst to spend their time reviewing. So the second bullet here is the operational efficiencies, where as those data attributes change with your customers, you now have the ability for automation within the system to be able to pull up those meaningful changes, create alerts, and then review those alerts as they're coming in and as that data changes. And it is one of those things that, from a phased approach, you can do this in a weekly or monthly basis, and then start to work towards more of a nightly basis, where you're constantly getting those updates and allowing for your KYC or CDD area to be more proactive versus reactive when it comes to monitoring your customer base. And then last but not least, and probably the most important, arguably, is the improved customer experience. So now you're no longer going in and looking at requiring updates from a customer, but you're taking what the system is pushed into the profile for these entities. And then you have the opportunity to use enrichment through this process as well. And by enrichment, I'm really talking about third-party data, potentially credit bureaus, other areas of information that might come in and help you stay current with a customer's updated profile. And it may not be relevant enough to create an alert, or it may be. So for an example, if you're getting information on someone who lives in Charlotte, North Carolina, but then ends up moving to Durham, North Carolina, that may not show a significant enough change in the risk to generate an alert, but you're then being able to use that credit information to update their profile and make sure that you have the most recent available information for that person. But in the same type of theme, what if that person moves from North Carolina to Syria? Obviously, that's going to be something that's going to negatively impact their score. And it's something you're going to want to review that alert and make a decision based off of whether or not that is a significant enough risk for you to continue doing business with that person. So, Nick, Andras, I'm not sure if you have other benefits that may touch on these that I might have missed, but just wanted to discuss a little bit of where moving to perpetual KYC could add a lot of benefit to the operational process inside the institutions today.
I can jump in there, Brian. Yeah, I think there's also a chance as well to get closer to the customer and understand how they're behaving. We also have to think about too what this means from a retail customer like you or I versus corporate type customers. There is a thought as well that maybe compliance could probably move more to particularly in the corporate sector, around a revenue generating center, because with perpetual KYC, you could start to monitor your customers and how they're operating. You've got a better, more real-time view of the products and services that they're taking, which can help relationship managers to have a much better understanding of how their customers are actually operating. So for example, a mergers and acquisition comes along, or they extend into a new market. If we've got that kind of intelligence, being pulled back straight to the customer record itself, then, the relationship manager can then start to rely on the data there about that customer and look at the product strategies and service offerings that may be appropriate without having to necessarily go out and do all that research themselves. Possibly a longer term view, but certainly direction of travel, I would like to see, where compliance becomes more of a trusted business partner with sales and the sales organization.
Yeah, I would add here, right, that continuous KYC, obviously having to do or wanting to do KYC, know your customer kinds of operations, periodically or on an as needed basis, obviously has overtaken this initial, just the old school, onboarding or application time, account opening type KYC screening kinds of methods, right? Because the world is changing, right? There's just a lot of geopolitical instability happening. There's a lot of new regulations coming up, and obviously that mandates, right, and forces financial services organizations to be compliant, right, and basically not fall out of compliance, right? So this initial onboarding time KYC or KYB, know your business, organizational KYC, is really not enough, right? It's important, but not enough moving forward. So that's the reason for wanting to do this periodically, as well as on a trigger basis, right? There's a change, or there's a risk factor involved, from transaction monitoring or from customer data changes, et cetera, out there as well.
Maybe one other thing to touch on, Andres, and I totally concur with what you said there, is I quite often look at it through the lens as well from an operational perspective, and you look at the analysts who are repapering the KYC profiles on an annual basis for high risk, or the 3 or 5 year cycles depending on the other ones. There's a lot of manual work there that shouldn't be done, so it chews up a lot of their time. I like the idea where we move to an exceptions-based piece where you're probably not going to achieve total pKYC, but if you got 60% of the profile automatically done, where there are conflicts or you need to have compliance or the analyst actually take an opinion and do a deep dive and really understand what the data changes actually mean, that adds value to their job role, as well as to the organization as well. So there's definitely an impact, I think, on quality and productivity and way of working that analysts would also benefit from.
Yeah, I think you guys hit a couple good points there. One, it's how efficient are some of these processes today, where you're just looking at going through the profiles and manually reviewing them because that's the way you've done it for the last couple of years, and now being more proactive in trying to get the meaningful type of alerts, the meaningful type of reviews that do impact the operation, that's of value to them. And then the other aspect of it is, and I think you both touched on this, where these results can then impact other lines of business. So if a customer is looking to open up a line of credit, maybe this information can be shared with that line of business so that you've got the ability to preload a lot of the information on that individual and approve that line of credit, that either loan or credit card, much more quickly than you would have in the past. So good points on that all the way around. Okay, so, and I think we've touched on this a little bit, but we hear a lot about periodic reviews in the space. So where does periodic reviews really make a difference? And then when should they be best utilized? And I think historically, where periodic reviews have really been the cornerstone of the business operations has been when that time frame comes up. Is this a high-risk customer that then needs to be reviewed every 6 months, every 3 months, et cetera? Is this something where they need to be reviewed every 6 months, every 3 months? You've identified that they've been a high-risk customer, but in reality, has anything from their business changed? Has any of their corporate structure shifted? Has any of the type of business that they are now in or the market that they're in shifted at all? And if it hasn't, why go through the process of then reviewing that if it's not necessarily needed? Now there are going to be exceptions to that, for example, and I think this gets into or segues into the customer segments where there is an absolute need for specific reasons for periodic reviews. If it's something like a MSB or a check casher, money service business, or a check casher, where you need to ensure they have certification, has their AML program been reviewed by the institution to ensure that they are doing things correctly? And then also, are you looking at being able to use those segments into other areas of your overall AML program? So are you using that periodic review to do a refresh on your high-risk customers to then look at how your rules are being addressed to that customer segment? So I think there's opportunity to help streamline some of the business in being able to utilize those risk scores from the customer into your transaction monitoring, for example, but then also from a business operations standpoint of how much do you need to do periodic reviews and therefore your EDD process. So are there additional pieces of information that you want to get into? Are there things that you need to verify with the customer, collect that data, and then be able to pull that back into the overall review and analysis of that entity? So Andras, Nick, I don't know if you agree with me or feel free to disagree with me on that, but happy to get your thoughts there.
I would say that the periodic reviews, obviously this is a very reactive type of thing, right? A customer does not appear right on a PEP list, right, or a sanction list coinciding with your review periods, right? So if basically you do your reviews today and the next review cycle is not due until next year, the same day, right? But this customer gets added to a list, right? Sanctions, PEP list, whatever, tomorrow, right? Then you're basically operating almost an entire year, right? Without being in compliance truly, right? So it's just so basically how things happen in the real world will not necessarily basically aligned with your periodic review cycles, right? I guess that's one thing I've also heard, right? That there's just like a lot of longer term. If it happens, your periodic reviews there's only every 3 years, 5 years, whatever, right? Then these extended periods can also be much more extended too, right? So.
Yeah, and if you take a look at what happened with either Ukraine and Russia and whatnot, I mean, obviously there's the sanctions component, but there's also those higher risk individuals that came up from that and are showing up on PEP and RCA lists that if you're not proactive about that, could slip through the cracks in a situation like that.
And the other thing is about periodic reviews, like you guys stated, right? 99% of these periodic reviews are not going to, you have to do them to get in compliance, right? But they're not going to, basically you're doing 99% of these periodic reviews are just going to be checking the box, right? And it's the 1%, right? Or where there's really a change in a delta and a difference, right? Or there's a trigger event because of transactional activity where you want to focus your manual efforts versus these other things can be definitely done, in many cases, automatically or semi-automatically.
Yeah, yeah, absolutely, and I would add as well to the question, can perpetual KYC actually replace periodic reviews? I think we have to think of it more holistically. It's got to be. This isn't just a technology play. It's not just purely data. It's got to be a kind of mind shift for the organization in terms of what are we trying to solve for, and to realize it's a journey as well. You're not going to be able to solve this for all lines of business and customer segments quickly. And a good example of that around which customer segments how should they best be utilized really depends a lot on where the data availability actually lies. So for retail customers relying on things like credit file bureau information that is a lot more current, and real-time kind of like PEP and sanctions updates, you can achieve that quicker than say more opaque jurisdictions where corporate data is not available as in such a rich format, or not available in such a timely format either. So I think you have to think about what the data availability and timeliness of the information that you can get and how that impacts the strategy the implementation and the approach.
Yeah, 'cause I think that it's a hot topic in the US at the moment, that the fact that we don't have a corporate register. And for example, they're looking to get that housed within FinCEN, and then allowing certain entities to gain access to that. So in other countries, the EU, for example, there is a corporate registry that has beneficial owners listed to it. So that does play a huge factor into, what are the institutions capable of doing, and how they're able to use some of that available information with the periodic reviews, and assuring that those are indeed accurate based off of, what information those customers do provide to them.
There's also the aspect, right, of watch list, internal watch list filtering and management, right? So a lot of larger financial organizations, they kind of bring in the data sources, right, from one of the well-known sources, right, and they kind of assemble, massage it, make sure there's no like regressions. They want to make sure that the quality stays the same. But obviously, this is not a real-time process, right? They bring in this watch list and do watch list filtering and management, once every quarter or every 6 months or whatever it is, right? So the periodicity of the reviews, right, of the actual reviews may not, kind of align with that either, right? So there's just a number of kind of like Nick said, there's a lot to be said about the data not being up to date or available or granular enough, right, or just right on schedule, right? And you still have to be in compliance as a financial services organization.
Good points. Okay, so I think with this session here, it's really how pKYC impacts CDD. So a bit of more of a couple of the areas that we've been touching on already, with first of all, improvements to the customer experience. So impact to the customer lifecycle, where you're now going through and only looking at significant changes with that customer in their life cycle within the institution. And what that really means is being able to make sure that they've got the ability to be contacted or notified when the information needs to be updated from their side as needed. So you're not pinging them and sending them messages on an annual basis or every 6 months, or looking to ensure that something is valid when it doesn't need to be. And then going through also, if you've got something that is stale and does need to be verified, it does need to be updated, you're going through this perpetual monitoring and overview of the information that exists, looking for potential stale dated information, and then tying back into the customer experience, where it's only being updated as needed and verifying with the customer as needed, and not something that is annoying or something that's bothersome to the customer that you have. And then Andras, you've mentioned this a couple times already, but making sure that you got support of in regulatory compliance when it comes to this sort of thing. So you're not having those gaps in the information that you're reviewing. You're not having those gaps with the watch list monitoring. You're not having those gaps with what the regulator may come in and say, look, this is deficient in the way that the process is running, and making sure that you have compliance with the spirit of KYC and CDD. And we know that these are relatively newer regulations in most regions around the globe. And in some cases, some regions, they're pending regulations that will be happening pretty soon. So there is a lot of, I think, fine tuning that's still taking place with CDD. And then the conversation is now perpetual KYC as to how that's going to end up being a much more streamlined process for these institutions. And obviously there will be some hurdles to overcome in what areas that may be more streamlined than others. But definitely interested to get your guys' thoughts on where we see pKYC impacting CDD as well.
Maybe I'll jump in then, just briefly on that. Yeah, Brian, I mean, I echo all these. I think from my perspective, it's where the rubber hits the road on this, and I think the regulatory side of that is really, really important to take into account, because whilst we think direction, we want to do this for all these good reasons, how do we know that we are staying within compliance? How do we know that actually say 60% of the stuff that we're automating is actually being refreshed properly. How do we demonstrate back to the regulator if and when they come in and audit those sorts of processes, or even internal audits, that we are actually hitting those refresh points and the data is correct? So I think there's an operational impact to be thought about in terms of how we, maybe do, particularly in the early days, how we do maybe more stringent reviews actually of those profiles to get to the level of confidence that the technology and the data that we are relying on is in fact doing its job in the background as stated on the tin. So we may want to think about considerations for that in the early days there may be a bigger impact on CDD operations until we can get to a point where going from crawling to running, from crawling to walking to running, and be able to demonstrate to internal audit and compliance that in fact we are moving in the right direction.
Yeah. Yeah, and I would say also, this has an impact. So basically, perpetual KYC has an impact on, what you're doing when, like in the customer due diligence, initial onboarding screening, and watch list management process, right? So basically, having transactional background, having a context around the user's activities, right? Even if it's a new account, right? It really will, help the CDD process, right, and kind of finish it off. Yes, you have to kind of demonstrate to your auditor and auditors, regulators that you've done, the CDD process at an onboarding time, right? But pKYC, you can maybe extend the scope, right? You may not have to do as much for the initial, CDD process than without, pKYC, right? Because you have all this additional safety net, right, in below or underneath you, right? That being pKYC, that will guarantee that you catch, problems or issues, right, in the CDD process, not just at a one-time kind of initial onboarding time, but over a protracted or perpetual kind of time frame during the entire customer journey or entire customer life cycle, not just at the very beginning.
Yeah, I think that's an important part. Like, you want to know the risk up front, but also the risk up front to ensure that this is something you want to do business, but then over the life cycle, because as somebody may join your institution, maybe they're in college, university, but then obviously they're going to change over the next 10, 20, 30 years. And that's what the banks want to do. They want to keep their customer during that time frame. Completely agree.
And CDD may not even, so even if you do your full CDD process, right, and there is, after a successful CDD process, right, that the customer's been onboarded and they start transacting, et cetera, pKYC actually highlights a deficiency or a question mark or an unsure point, right, around this customer's identity, then you can obviously always revisit that, and then you can just plug this hole or kind of check the box. Not just for the regulatory side of things, right? I mean, we've been all talking about, AML schemes and regimes and requirements and regulators and, kind of digging the financial services organization, but there's also the fraud side of things, right? So, getting all of these assurances and getting all these extra checks, that and basically additional kind of scrutiny that pKYC can bring to the surface, right? These pieces of kind of these kind of investigations or additional data collection or additional kind of vetting and proofing of the customer also comes in very comes in very, very handy in order to detect new account fraud or prevent new account fraud kinds of activities, right? Keep in mind, right, that money launderers are never just solely focused on money laundering, right? They kind of jump ship, right, and kind of get out of their comfort zone, so to say, and do all kinds of bad things like fraudulent activities, fraudulent payments. So there's usually a correlation between fraud and money laundering, and then pKYC I think really helps bridging the gap with the fraud aspect of operations as well.
Yeah, no, I would strongly agree with that. And I think that's a good point, because one of the areas of vulnerability for a lot of institutions is during that onboarding process. You don't know this person as they're coming in and what their intent is, right? So you want to make sure that you're doing everything that you can to vet that out. not only from the compliance side of it, but also from the fraud side of it, because they could come in and 2-point new account fraud, or the forget the term, but get a line of credit, cash that out, and disappear.
Yeah. Synthetic identity fraud or loan origination fraud, or there's a number of things. Identity theft. Yeah. Totally.
Yeah, I just echo, certainly. I mean, having those fraud signals into AML, into the CDD process, and vice versa is certainly direction of travel where we're seeing our customers are getting really interested in.
Yeah, it's a big problem. Okay, I think at this point, what I'm going to do is stop sharing, and Andras, I'm going to hand it over to you to present your slides from initial,
sure.
and then
Absolutely.
kick it back over to the poll question, and then Nick to close this out here.
Okay, very beautiful.
So let me stop sharing to share my screen.
Okay, and let me jump into my presentation here. So now this is it. Okay. Can you guys see my slides and hear me?
Yeah,
at the same time.
all good.
Gotcha.
Thank you. Okay, great. So again, good to be here. Really appreciate the time, guys. Apologies some of the audio issues earlier. I wanted to kind of look at and kind of show a view from a slightly different angle, right? Kind of look at what we hear at Forrester from end user customer organizations, what the requirements are, and kind of broadly looking at this whole kind of ecosystem and larger, kind of more kind of fisheye lens view, right? So if we look at why this is important, right, at a much higher level, right? Online customer acquisition and the regulatory aspects really drive or limit, customer expansion, right? So if you have an ineffective AML regime, right, then basically that contributes to a bad reputation or bad, customer protection thing. So if you're bugging people unnecessarily because you don't have your processes right, or you're just asking too many questions too frequently, right? These periodic things that we thought about earlier, that is going to have a negative impact on the customer experience. The regulators are relentless, right? I mean, I think we can all agree on this. There's the depth and breadth of these regulations is only going in one direction, right? It's not going to be less complicated or less onerous, right? I think we can agree on it. We see a lot of like human trafficking, beneficiary ownership, and you name it. There's just a lot of kind of questions and regulatory things. And the regulators are becoming savvy, right? As they're seeing more and more of these kind of business operations, they're looking at platforms, they're looking at technology, they're asking more and more relevant and obviously difficult questions, right? The online customer acquisition retention, if a bank wants to be able to compete with its peers, right, they cannot do all this manually, right? The cost and efficiencies are if you have to hire an army of investigators and analysts to do this well, you basically put yourself out of business as a bank, right, or financial services organization. There's also these new payment transaction types, right? Like peer-to-peer payments, Venmo, TransferWise, Revolut, and others, right? That really kind of move AML beyond the badge-based, kind of reactive thing to much more of the proactive and real-time side of things. Because once in peer-to-peer payments, the customer kind of hits the button, right? Then the money's gone, right? And then from that point on, A, you're liable to fraud as a bank, and B, you really have to explain to your auditors why you're letting money laundering operations, go through. And I think it's naive to think that money launderers will only use online bill pay, right, and wire and ACH transfers to launder money. They kind of are aware of the entire breadth and spectrum of transaction types that they can try. And then, data integration rules are still, are there. It's really one of the biggest challenges at an organization, how you kind of get all the transactional systems data into an AML system or fraud management system, how you kind of correlate all this. So definitely not an easy thing. As I thought about the compliance regulatory landscape getting tougher, right? it is not just the various directives on an AML, but there's GDPR, privacy kinds of questions. The Payment Services Directive, PSD, especially in Europe, that forces a lot of movement, even indirectly, right? We see beneficiary ownership. We see the need for consortium information. So you cannot really do this whole exercise, this money laundering, AML set of activities, pKYC, without actually using some consortium information. I'm going to talk more about this. And then the personal liability, the motivation, right, for a lot of large financial services organizations is that, their CFO, CIO, CEO, CSO, CISO, and CS as a chief risk officer, can go to jail, right, if they're doing this as well. I think this is a very important kind of thing that is a huge enough motivator for a lot of organizations. So what do we see as being the drivers to implement KYC now? So compliance, right? It's just you gotta have to do what the regulator is telling you, otherwise they'll just revoke your license, right? Cost cutting, to be on par with your competitors, you have to basically automate things. The agility and lower security are also there. So lower security is basically in order to avoid like a decrease in security, you have to obviously do KYC. And this is all in line with FRAML, or fraud management in AML, and bringing in account takeover into the picture. That all these elements, right, all these investigative KYC, CDD time activities really improve security. So basically, the driver is just the security has been kind of being eroded, and kind of bring it back to the level it was before. It kind of necessitates better KYC processes. Business agility, right? So people, as we discussed here, banks, financial services organizations, they want to focus on new customer acquisition, introducing new products, investment products, new types of services, right? And not worry necessarily about these kinds of fairly mundane and onerous processes, right? This is always the how do we become a better bank, an investment firm, a mortgage company, et cetera, and provide better products and services in our core competency areas, instead of being bogged down on just worrying about the AML, KYC, et cetera. And the customer experience absolutely contributes to this. So if there's high friction, if in AML, or KYC CDD time, you are bogging people unnecessarily, right? That A, has an impact on operational efficiencies and labor costs, but B, it also alienates the customer, right? And if an organization in a bank or financial services organization is basically making false accusations, like submitting or creating false or untrue suspicious activity reports, it can have a lot of, even legal consequences that you don't want to take on, right? Beyond just the goodwill and reputational problems that might cause. So again, this is just a kind of taxonomy chart, right, as to how we see the world of AML, right? On the left-hand side, this is the CDD. This is where you have the KYC processes as well. I think we've talked about the fact that this is going to be an inherently complex process, right? There's just a lot of things you have to look at here. The verification, the onboarding, the physical identity document verification process, the screening, PEP checks, OFAC checks, sanctions checks, adverse media, and other types of activities that really have to happen. A lot of times you have basically document management requirements as well. So there's a lot of kind of moving parts of this whole process, right, of the KYC process and the AML process that really mandate the automations. It's a complex world. So basically, why KYC? Basically, the mandate of KYC operations and in the US BSA, you cannot operate as a financial services organization, right, without doing this. Basically, there's a lot of overlap between CDD and enhanced customer due diligence with KYC. Definitely an important element. And then the screening is always a requirement, right? And then we thought about watch lists, we thought about the periodic nature of the updates to this watch list, the filtering, management, regression, avoidance, the politically exposed persons list, like with all the new kinds of political developments in the world, people get added to these lists that you have to maybe retrospectively notice, detect that, some of your customers are actually, kind of are entered or added to a PEP list or adverse media list or sanction list. And then there's always, the whole kind of ecosystem of internal hot lists, right? So at a large organization, all this is not just going to happen. If you have retail banking, if your organization does not work with like other internal lines of businesses, like if you have a mortgage kind of lending operation or credit card business or corporate banking or investment banking or any of these things, and you're not noticing that this specific person already has been identified as a money launderer in your corporate banking environment, and now you're allowing them to launder money in your retail banking environment, that is not a good thing. The regulator won't like that at all. So definitely an important element. eKYC or electronic KYC is definitely, kind of connecting the physical and digital artifacts and relying more and more kind of in an operational manner on documents, right, as well as electronic methods and electronic sources of information. So physical identity document verification is definitely something that is increasingly being automated, taking pictures of plastic identity cards, then doing a selfie of the person and then comparing the picture on the driver's license with the selfie that was captured. Public records based identity, this is the credit file header based questions, how what was your monthly mortgage payment or what's your monthly loan amount, and these kinds of elements are still out there, although they're losing their appeal because, again, customer friction. Email address reputation, phone number reputation. Is this email address just brand new, or has it been used on the internet for 20 plus years? Different kind of levels of risk. Is this phone number a prepaid, postpaid number, landline, just ported number? Is this device a device that's been seen in conjunction with previous fraudulent or money laundering activities? And then obviously behavioral biometrics, how you move the mouse, swipe the screen, kinds of activities are also important. And then, the whole entity resolution is also an interesting question, right? A lot of times in these KYC activities, you have to be able to collapse nodes in your customer tree. So sometimes money launderers or fraudsters sign up basically with the same set of attributes, right? Name, phone number, address, etc., under two different names, right, or very similar looking names. And if an organization, if a bank does not actually catch that, then you're going to be seeing, you're providing your money launderers, a lot of extra kind of ground and breathing room to kind of do their nefarious activities. So entity resolution is basically making sure that you're recognizing on a periodic and automated basis that you are, that two customers who appear as two independent customers in all your transactional systems are in fact the same human being or organization. And then obviously the traditional documents, bills and everything, kind of proof of address, like, utility bills or mobile phone bills, etc. They're still important, but their management is becoming more and more costly, and basically it's easier and easier to kind of create these documents fraudulently. Why perpetual KYC, right? Or pKYC? As I said, the entity's reputation can change over time, right? The kind of cadence of updates for watch lists is not going to coincide with your internal, with an organizational kind of update frequency. The entity interrelationships change, right? The whole idea of money laundering is that there's transactions that point to the kind of a notion that there is definitely some kind of structuring or layering or other kinds of money laundering happening, right? So And that needs to be reflected in entity interrelationships. And if you're doing a visual link analysis of transactions, people, phone numbers, addresses, etc., you should be able to see this, right? And these types of changes, if they're going to a direction that basically point to money laundering activity happening, have to trigger some kind of a recheck of the customer. Customers' enrollment with various products and services change, right? So there's basically, as I said, money launderers are not gonna stay put, right? They know banks, organizations, products within these organizations sometimes a lot better than the bank knows their own kind of products and services, right? So that's definitely an important thing. And then all this means more opportunities for money laundering and fraudulent activity. So solution, we hear about the periodic as well as perpetual KYC, segmenting customers and kind of moving by segments or focusing on risky segments of customers, maybe in some jurisdictions, geographies, or kind of groups of customers. Repeating the identity verification process, so basically asking to customers to re-verify their identities, maybe using different sources. Repeating the rescreening process and use risk signals to basically trigger some rescreening processes, again checking that this customer is still not on a PEP list or adverse media list, and augmenting all these with transactional monitoring results, right? These are relationships of the customer to other customers as well. And as we stated, that these blind periodic, I can only confirm this, these blind periodic KYC processes are way too expensive, and you need a much more strategic approach here. Some recommendations, right? So link graphs and social network analysis or visual link analysis is definitely important. Identifying broader customer activity and segmentation dynamically. So it's not like customers bigger than this size of assets, but lower than that side of assets in their account. Money launderers are smart enough. They know your thresholds basically much better than you do, right? Integrate the mobile fraud, mobile device with other channels and build a user and device behavioral aspects to detect anomalous and fraudulent behaviors. Basically using multiple tools, like we thought about, the visual link analysis, the physical identity document checking, the behavioral biometrics. Is this enrollment activity or the ongoing activity of the user in the session, in the account, consistent with what they've been doing before? Is it a robot? Is it a human being? These are all important things. And identifying falsified account statements with document management tools. As I said, this is also increasingly being automated. Using basically in terms of recommendations, third-party list source integration. The more of these lists you're looking at, and the more you're able to kind of manage them, the better. Refining the matching algorithms using artificial intelligence and natural language processing is definitely important. As I said, the regular expression matching is not necessarily good. Supporting more types of transactions. It's not just like an ACH wire, but there's also Zelle, Venmo, Revolut, and other kinds of transactions that you have to look into. The whole model governance and explainability, you have to have that in the background, because without those, you're not able to explain to your auditor, why you triggered that, perpetual or on-demand KYC process, or other kinds of sanctions or activities, or compliance report for compliance related reports being filed. Basically, we see a lot of improvements in the artificial intelligence and machine learning kinds of models, and we're looking at cryptocurrency and real-time based improvements as well. The model governance, right? I think it should never be a fishing trip. Making sure the next challenger model is going to work better than your current champion model. This is a background for systematic as well as effective pKYC. Statistical measurements and SDLC processes to manage the models is a must here. And it's obviously unsupervised models can be more difficult than supervised models in AI. And working with regulators, FinCEN and FINRA, and various other international agencies is always going to be a must here. some future kind of trends here. Cloud-based analytics and delivery, again, it's because of lower operations costs, but also better ways and better ability to bring in consortium data as is there. Predictive investigation, again, looking at based on the relationship of entities, phone numbers, names, addresses, etc. Once an investigator identifies and looks at a certain case or alert, the system should be able to actually recommend to the investigator other areas or cases or transactions to look at based on the outcome of an investigation. Decentralized digital identity or self-sovereign identity will have an impact on all this. It's the digitized way of having a government digital driver's license or passport being issued and then being accepted by banks. This will generally have a huge positive impact on CDD processes. And then, pKYC happening quarterly or on an as-needed basis for continuous compliance. So with that, I just wanted to kind of conclude my part, and then maybe we have questions or additional discussion. Happy to do that as well.
Thank you very much, Andras. So I think we're going to take Q&A maybe towards the end here, but what I wanted to do is give an opportunity to do the second poll question that we've got. So let me go ahead and share my screen here, and then we could put the second poll question up there. Okay, so what is the largest hurdle to implementing pKYC? We've got options such as the business case, which is, I guess, justifying the need to do so. The data quality, what are some of the things that are coming in to allow for pKYC? Buy-in from senior leadership, or nothing at all. You guys are well on your way. So we'll allow you guys to make that decision here, or that choice, I should say. While people are making that decision, Nick, don't know if you want to maybe jump in on survey results slide.
Yeah, please. Thank you, Brian.
Yep.
Okay, so while you guys are just voting, we thought we'd bring up a sample of our latest global AML survey for financial institutions that we actually launched yesterday, or was available to everybody yesterday. And it's a sizable piece of work, and we just thought we'd highlight what some of the key results or key findings were. The survey, we received over 630 odd responses. We selected 9 questions and divided those into 4 specific categories. So there is as I say, it's global, so we've looked at it by region. We've got insights there by roles of people who've responded. So there's a rich amount of information in there. It will be available to you guys as well, as I think as part of the as a link basically at the end of this presentation as well. But should we just jump back into the poll before we discuss the results?
Yeah, so it looks like 70% of the respondents said that data quality is the largest hurdle, which isn't really surprising considering everything starts with data, correct?
Indeed. Yeah, so interestingly, the business case at 13 and then buy-in as well around 17%. So I think that does go back to what we were saying previously around it's more than simply a technology play. You've got to get stakeholder engagement, buy-in, before I think you can even think about the business case around that. So it is a journey. Very conscious of time here, so I will jump in quickly around this. So one of the top goals for 2022 and beyond was the major poll question that we asked in the survey. Unsurprisingly, 54% said that achieving pKYC is a top priority, which, given everything that we've spoken about so far, the complexity of regulations, the sheer cost of compliance globally. I mean, I think we're looking at something like 200 billion annually spent for FIs around the whole AML CDD compliance space. So being able to be more effective, reduce costs, but also be more, but also produce higher results as well. And using pKYC as that vehicle, clearly is top of mind for everybody. Andras, I don't know if you wanted to jump in and add anything more to that.
Yeah, can you hear me?
Yep.
Yeah, definitely, anecdotally, we see similar things, right? I mean, this is just hitting organizations, invariably, right? And I guess I would definitely agree with you, Nick, that this is not just a technology play, right? It's not like you have a transaction monitoring tool. I think the pKYC also may result, or actually will result in re-architecting the onboarding process, or kind of rethinking, restructuring your CDD and initial onboarding time, identity verification, and KYC processes. Even I would say this may also trigger a complete rethinking of watch list management, filtering, internal kinds of activities, right? How you're able in your organization to do a much better job of keeping your sanctions sources or lists up to date, right? In a company. So definitely,
Indeed, yeah.
important element there. And then I think it also requires even more data integration than previous types of technologies, right? I mean, that is, it's just it's not just a technology play, but doing it well requires additional technology and additional kind of effort and work and kinds of preparation, for sure.
Yeah, absolutely. Maybe one more than Brian on this.
Yep.
Did you want to? Yeah. Okay. So when we looked at what are the actual top 3 goals really by region there, again, these all I think play very nicely to what we were saying. So achieving pKYC clearly top of mind, but also reducing false positives. We still that still represents such a massive issue for transaction monitoring and customer screening. It's got to be addressed. I mean, that's a huge piece of low-hanging fruit, which use of AI and machine learning, better data quality. Then I think we can start to deliver on that as well. And also accelerating AML investigations. Again, that can be a technology play to help with that too.
Yeah.
There's great opportunity there to do that. Now, interestingly, when we look at the differences between North America and versus APAC, Europe and EU and EMEA, then whilst they're all broadly aligned here, we think potentially the reduction in false positives for North America and LATAM areas may be due to increased transaction sizes, and the fact that that still represents the biggest pain point for banks in that region.
Yeah, I think false positives has been something that has been around for a long time, and I don't see that going away. Reducing false positives is probably going to be something that's a goal for now until you finally get to that number being somewhat manageable. I don't know what the magic number is. I've heard reports of 30% or so, but that'll always be, imagine, the top 3 here. But it is definitely interesting to see something new with pKYC and the adoption there. And then I think accelerating the AML investigations, it's that operational efficiency play that has been talked about. And Josh, I know before you've spoken about automation when it comes to bots and things where you can pull in different data sources to help with the investigation as well. So there's certainly areas of opportunity here, but having consistency across the different regions, I think, is telling in the fact that everybody's struggling with the same problems there.
Yeah, totally.
Okay.
Next slide.
Next slide, please. Yep.
Yep.
Yeah, so top data challenges and pain points. So gaining a broader and deeper access to external data on individuals. That was 54%, which again is not surprising. If we're trying to achieve pKYC, then there is a heavy reliance on generally on external data for the validation processes, and again having it in a timely manner, a timely format, and what that means to the organization, the operations.
Especially external data, also, like I said, consortium data, right? That is super kind of, we hear that coming up all the time, right? So what other organizations see, what other banks, financial institutions are seeing, beyond the getting together around the round table every month, kind of talking about things that are like the most kind of pointed problems, money laundering activities or patterns, right, is one thing. But this kind of periodic meeting is no substitute, right, for the hardcore kind of pulling information about known money launderers, known endpoints, known patterns, new kinds of known types of transaction, kind of activity that other banks have seen, and it's coming to you, right? So it's almost like a tidal wave, right? These money launderers and hackers, they kind of tend to do things and hit banks in waves, right? So if you just at a point where it hasn't yet hit you, it is very helpful to kind of learn from the learnings of all of the 15 other banks that have already been hit by this type of thing, right? So learn from other people's mistakes, so to say.
Yep.
Next one then, Brian. So the future of AML and KYC data over the next 5 years, unsurprisingly, as we looked at before, data integration across the platform, automation of that data, being able to get more data, deeper data, is clearly a huge priority for people. It's fundamental in terms of it driving pKYC as well. So I think all of these themes they all roll up very nicely into, we're doing pKYC because we're trying to reduce costs, be more effective, and we're trying to do it in a smarter way to free up resources and be more regulatory compliant as well. And Ed, thoughts from you too as well, maybe?
Yeah, I think as Andra actually pointed out, like there's obviously third-party enrichment data that you can get, but much in the way that I think fraud shares some of this information with bad actors from one institution to the next, it's going to be very important for those institutions to share the same thing about KYC data, whether somebody has been a bad actor at their institution or defaulted on a line of credit or what have you, if that information has been found to be fraudulent that they provided to the institution. I think consortium is an area of opportunity where banks need to get it together, as well as the information that's coming from different data providers as well.
I would also add that, two thoughts here, right? One, the collation of data, right? So this is where we see the identity resolution, the collapsing the nodes, kind of on a graph kinds of activities, but also imbuing some kind of a topology-based risk score into transactional decisioning and investigation, right? So it's one thing, right, that an investigator can bring up like a topology diagram or visual network analysis, visual link analysis between entities, names, addresses, phone numbers, etc., account numbers, right? But to operationalize, so basically it's not as efficient as having an algorithm or a tool that actually creates like a risk score or has an impact on the transactional risk score based on the topology of the visual link analysis or this whole kind of interrelationship graph around that entity automatically. And I think the automatically is the important thing here. So it's not like a eye candy and then just kind of rotating and then zooming in and zooming out of these visual link analysis graphs, right, manually by an investigator, but the system having a much more accurate and consistent evaluation of the topology of these graphs and add that kind of contextual information to the transactional risk score. So that's one thing. The other one, data federation, right? So I think it's important to kind of realize that collating and collecting all this data into one gigantic database, right, is not efficient. You have to be able to think about, as an end user organization, methods as to how you're able to federate or create virtual views of the data that you and other organizations or your vendor may have, so that you get a better picture. So definitely that's an important element here.
Yeah, so great points. So I think that comes to the Q&A session if we've got time.
Yeah, no, we kind of ran over. So Lauren, I don't know if we've got time for Q&A. If there's any in the hopper, or we can answer any offline. Kind of, I'm not sure where to proceed here.
Yeah, that's all right. I know we had kind of a time hiccup there, but I think otherwise, we will go ahead and wrap up pretty soon here. If anybody has any kind of final notes, any final thoughts to leave us with, but we can leave an opportunity for, and also just for everybody who just joined, we will have the recording of this webinar. I believe there may have been a Central Time, Eastern Time hiccup with the setup of the webinar, so I apologize for any confusion there. But otherwise, we will have the full recording of this webinar available on the FeedSci website, and we will be emailing all registrants with that recording. And so please feel free to reach out to us. Let us know if you had any questions that we didn't have time to get to today. But yeah, for our three speakers, any kind of final notes, any final words of wisdom before we wrap up?
Josh, I'll defer to our guest speaker and see if you've
Perfect.
got
So I mean, I think automation, better accuracy, and reducing false positives, pKYC, right, and just better regulatory compliance, they all walk hand in hand, right? This is not a, like, you cannot just really tactically kind of enter this whole activity set and hope that things will magically happen. There's also the importance of governance and of internal processes, which Oli alluded to in this whole conversation. So yeah.
Yeah, I think those are all very important, and this is a reality that is coming very quickly. And you've got to be proactive. You can't wait on this to have a reactive process. There are expectations from the regulator. There are expectations from the industry about how you're proactively monitoring your customer base and have assurances around understanding the risk and the potential behavior. Nick.
Well, more philosophical than anything else. I mean, the game never ends, does it? In terms of what we're trying to achieve here, it's a fascinating topic. It's capturing more and more in terms of typologies and where the whole financial crime space is going. So interesting times, but huge opportunities, I think, to make some real improvements.
Agreed.
Great. Well, thank you again, all three of you, for this excellent presentation. And thank you all for joining us again. We will have the recording of this available, and we will email all of our attendees as soon as that is published on the website, so you can go back and watch. And please let us know either with the requested demo format, or we'll also include some contact information in the post-webinar email if you had any questions that we did not have a chance to get around to after you watched the on-demand, or just if you came with questions prepared. But otherwise, thanks again to our speakers, and thank you all for joining us today.
Thank you.
Thank you.